because the leverage ETFs work on a daily basis. They're very, very dangerous. So we shouldn't really touch leverage ETFs unless it's for that day's trading.
Okay.
Any other questions?
Yeah, you mentioned that you don't diversify very much. And would you not think that diversification could help amateur traders?
Yes, 100%. If you don't know what you're doing, diversify. 100%. There's no doubt about it.
Okay. Hold on, let me take diversification. Why do people need to diversify?
Because
they don't know unlimited risk. Yeah. But if you know your risk is limited, right, you can be in 10 stocks and have limited risk. So why have 10 stocks? Why have 10 headaches? Yeah. So an average number of stocks that even we would have in our portfolio is 7 to 10. And that's, even if you're running, most of our clients are running portfolios of between $500 to $1 million. So you've got 7 to 10 stocks to worry about. You get to know those stocks inside out without even being in front of the computer. You know Microsoft's down to 22, maybe I should buy some more. Yeah, you get to know the stock really inside out. You get to know the support resistance for every stock. It's impossible to do that the minute you start going above 10 to 15 stocks. There's no way you can know all the stocks if you've got more than 10 to 15 stocks in your portfolio. It's very difficult.
And anyway, when you're using ETFs, you've got instant diversification in your portfolio anyway, across sectors. So you don't have to worry about, you know, for example, Apple versus Microsoft. That's not going to be an issue for you. Okay.
Your investment in QQQ is in 100 NASDAQ stocks. So it gives you instant diversification into 100 stocks. And QQQ moves up or down $5 or $6 a month. You can go to sleep, you can have 1,000 of those, you know your account value is going to be up 5,000, maybe down 5,000 at the worst situation.
Okay, so ETFs allow retail investors to invest in sectors just like institutions have done for years. Okay, you can buy a basket of stocks in a sector with just one stock purchase. It eliminates single company risks. Okay, for example, the Lehman Brothers risk, you could get into a financial ETF, and the ETF went down because the whole financial sector went down, but you wouldn't have had the risk on Lehman Brothers. Okay, it's less capital is required for spreading your investment risk. ETFs are available for all major sectors. Any major sector you can think of, they're available. And ETFs are available for individual countries as well. If you want to invest in Brazil, China, you know, Japan, wherever you want to invest, there's an ETF available for it. The ETFs allow you to take advantage of the power of sectors. Okay, and your most important consideration is to be right about the sector, because 70% of the stock's performance is related to the sector performance. 70% of the stock's performance is related to the sector performance. Even a lousy company in a good sector generates a good profit because the sector carries it up.
If you're in the right sector, the wrong company, you will make money. The sectors are so important. This is why markets tend to go up, all the mining shares are going up, gold's going up, etc. It's that particular sector. You can buy anything and it will go up. When the financials crashed and the housing crashed, any housing shares, they all went down. So no matter how much research you do, look at fundamentals, whatever you look at, there's no way, right, you're going to make money if that sector's going down. That's how powerful the sectors are. And this is how institutions have always invested. Retail investors can't go out and buy 50 shares, for example, in the mining index, while institutions can. But now, with ETFs, you can do that just by buying one stock.
Okay, and ETFs are available for all major sectors. Look for the best performing sector first, then look for the ETF or the stock, depending on what you want to do. Okay, and we keep a list of ETFs arranged in sectors, and we update that regularly for our students. Okay, so ETFs are just a few facts, basic facts about ETFs. They're traded just like stocks. Mutual fund prices are set at the end of the day. ETFs have lower management costs. ETFs are marginable stocks. Anyone started using margin loans in their investing? A little bit? Yeah, what sort of margin are you using? What sort of percentage?
2%. 200%, sorry.
Are you using RECTI or?
Actually, it's currency trading.
It's currency
Are you
trading.
in currency?
Yeah, so it's a bit different.
Yeah, that's a mega leverage.
Okay. There's tax advantages to ETFs. You've got industry-specific ETFs and country-specific. Some ETFs pay monthly dividends. So who's heard of a stock paying monthly dividends? Okay, that's another powerful strategy that we use for accounts for people that want to go and set up a foundation, what we call a foundation portfolio for their retirement. They're getting to monthly dividend-paying stocks or ETFs. So they're getting a consistent income on a monthly basis. And there's asset-specific ETFs, whether you want gold, silver, currency, etc., etc. You can get into those ETFs. Okay, so we only trade ETFs with limited or even zero downside risk. We leave an unlimited upside profit potential. We get paid to own ETFs because we generate cash flow on those. ETFs are marginable, so you can leverage. We leverage our stocks, and it's very, very safe. It's much safer to do with a protected account than an unprotected account. You can have dividend-paying ETFs, and our service will get you into the right sector at the right time, the right country, and asset ETFs. That's very, very important.
What is the highest dividend you guys have normally heard of on a stock? Average dividend?
It's about like 4%, 4 or 5%.
Per annum, yeah.
How would you like to get into a stock that pays 21% today, and you're paid on a monthly basis?
That would be lovely.
20% per annum dividend. You don't have to do a thing, just buy the stock and you get 20%. Imagine you're financing that with a 2% loan.
Be good.
Yeah? That means if you're even just borrowing 50% on a standard margin account, you're getting a 40% return on your investment without doing a thing. That's how powerful dividend investing and income generation gets. Because the more you leverage, the higher your return on investment. Yeah? If you're only putting down 20%, which is what a lot of portfolio margin accounts do, right? Putting down 20% and you're getting a 20% return, what's your return on investment? Let's see who's
100%.
awake. 100%. 100% return on your money. Without doing a thing, without having to worry about where the market's going because you protected it.
And can I just say, for those that don't know about margin, portfolio margin is just based, the margin is calculated on the risk of the portfolio. So obviously the less risk in the portfolio, the more margin you can get. Simple as that.
Okay, quickly run through a couple of the ETFs.
Take
that
some
are
notes, guys.
really
These are some
big.
important ETFs.
SPY is the ETF for the S&P 500. It's 500 shares. If you buy SPY, your investment is going into all those companies, XOMG, Citigroup, Microsoft, 500 companies in fact. So it's very, very spread out. Diversification with just one trade. This is the chart for the 2nd of November. As you can see, you get paid to own your ETFs. The D in the chart is the actual dividend payment on SPY, which is 2%, around about 2% per annum. So it's not a lot of dividend, but it's still better than nothing. So when you're using a lot of leverage, that dividend works out to your return on investment is quite high. So you can get a 10% dividend on something like SPY if you're leveraging 5 to 6 times. This is the Diamond. Diamond is DIA, is the ETF for the Dow Jones Industrial. You buy DIA, you're buying all 30 stocks in the Dow Jones Industrial Average. Once again, 2 years Dow Jones, you can see it's gone all the way from 13,000, 9,000.